The first lesson that I've learned over 12 brutal years is that there's only one thing that moves the markets. It's not indicators, it's not Fibonacci, retracements, or numbers. None of that. The only thing that you want to concern yourself with are orders. So any strategy that you trade should revolve around the idea of finding where the most amount of orders are sitting. That is the only thing that moves the market, whether the orders are sitting there or maybe it's an area where orders are likely to come into the market. It doesn't matter. If you don't have orders, the market won't move. If you don't have participants, the market doesn't move, right? So over the course of 12 years, I've developed a strategy. Now I have a whole video on this strategy. You can click it on the top right corner there, or top left corner, whatever it is. And that is using two different concepts, supply and demand, and liquidity sweeps. Okay, now if you're a beginner, these may sound confusing, but luckily for you, I've illustrated what this looks like right here, and we're going to take a look at some examples. Okay, so firstly, supply and demand is pretty much looking for imbalance in the market. So what this usually looks like is an area of consolidation followed by a massive continuation in that direction. Okay, so what happens here is that when you get this consolidation, you obviously have people both buying and selling, and then once you get a massive imbalance between those buyers and sellers, in this case it was the buyers, okay, you get a massive continuation or a massive move higher, leaving both the short sellers that got short in this consolidation as well as the people that wanted to buy in this area. Both of them are now in a little bit of trouble. More so the people that got short, right? Because now they're in a lot of pain, right? They're losing money. But also the people that weren't able to purchase at this level now have their orders left unfilled. And so this creates an area where there are orders sitting, right? You have the people that got short putting their stop losses or break even points in this area, and then you have the people that wanted to buy also putting their orders here to buy, right? So this is what we call supply and demand, basically imbalances in the market. The next concept you want to know is liquidity. So basically, again, where are the orders? Well, there are usually tons of orders resting beneath lows and highs. Why is this? Because that is what everybody is taught to do, right? If you buy, let's say here or here, where are you putting your stop loss? Most likely below this low, right? So your orders go below this low. And vice versa, if you are, let's say, shorting either here or here, where are your stop losses going? They're going right above this high, right? So your orders are sitting above that high. So if you've noticed by now, and this is something that a lot of traders struggle with, is that you'll get stopped out only to have the market move in your direction, right? Well, that's because the market is going to use your orders as liquidity, or institutional buyers and sellers are using those orders resting there as liquidity. This may sound hocus pocus, but there are actual entire studies done on where traders put their stop losses, where liquidity lies, and the number one spot where liquidity lies, or orders lie, are right here and here, below lows and above highs. So you combine these two together, supply and demand and liquidity, and basically you are creating what I like to call order zones, okay? And we're going to take a look at some examples here of both of these in action. Now, this isn't a strategy video, so I'm not going to go super in depth, but I may as well show you the logic and what is working for me right now after 12 years. This is basically what I have found to work and be one of the only things that I have found to work consistently. Okay, so right here we have an example of an area of demand. We have a consolidation, right, by these three candles, and then a continuation away from this area, a sharp continuation higher, creating an imbalance, right? So we know an imbalance is in that area. Then we have a low set right over here. We create new highs. So where is the point that most likely has the most amount of orders sitting? It's going to be basically from here to here, okay? And you can see right there, that worked very well. Another example right here, again, we have a little bit of a consolidation and then a massive continuation causing an imbalance. All right, then we have a low form right in here. We sweep the low, we take out that liquidity into the level of demand, and obviously that was an insane move higher, okay? And again, we have a low right here, and we have another low right here for a little bit of a double bottom. So we have orders resting below this area. We have a consolidation candle here, followed by a massive continuation. And so Your zone is right here. This is where the imbalance occurred. It's below that level of liquidity, so we know there are plenty of orders below there as well. So the zone that is likely to have the most orders is going to be right in this gray zone you see right there. Now let's take a look at some sell examples. So right here we don't have any liquidity, but it is an example of supply imbalance to the downside. Okay, you can see we have this consolidation candle followed by an imbalance to the downside. We come right back into that area. Perfect short opportunity down to new lows. Same thing over here. We have a consolidation candle. Not really the best example, but it is nonetheless the candle or the consolidation that happened prior to this move. So this is our area of supply. Then we have price come right into that area of supply and boom, again, down to new lows. Okay, and once again, we have an area of consolidation before that massive move lower. So this is our area of supply. This time, we even have these previous highs where orders are resting above, stop losses resting above this area. We come into this area of supply, take out all that liquidity, and once again, another perfect short. So the thing that I've learned in the past 12 years is that you always want to be looking for where the orders are, okay? Think in that framework. Where are the most orders sitting and how can I basically bet against them? Because essentially 99% of retail traders lose money, so you want to bet against the 99%. Lesson number 2 after 12 years of trading, and this is probably the one that took me the longest time to actually realize and accept. And that is the fact that there is no holy grail strategy in trading. The holy grail strategy is not blowing up. I know it sounds very boring and anticlimactic, but if you think that you are going to come across some magical strategy that is going to make you a millionaire profitable trader without having any good risk management or any risk management rules, then you are sadly mistaken. Almost any strategy, believe it or not, can be turned into a profitable strategy if you have the proper risk management. As long as you don't blow up, you will eventually win in this game. So what does good risk management actually look like? Well, for me, what I've learned over the years, especially more recently, is that the key is 2 things: asymmetric risk to reward and dynamic risk, okay? This will be your superpower. Now, what does this actually look like, okay? This is an example of a trade that I took in the Discord earlier this week. Make sure to join that up whenever you get a chance. It's absolutely free. Link in the description. But you can see that my risk to reward is extremely asymmetrical. What does that mean? It just means that the amount of money that I potentially stand to gain is always many times greater than the amount of risk that I actually put on the table, okay? So you can see right here, my stop loss is up here, but my actual stop loss was down here. It started down here, okay? And this is where dynamic risk comes in. Not only do you want to have asymmetric risk to reward at all times with every trade, but as soon as that trade starts to move in your direction, you want to be moving your stop loss closer and closer to your break even so that you can continuously decrease the amount of risk you have on the trade. What this does is that it keeps the math in your favor. So let's say, for example, this trade started off with my stop loss over here, okay? Well, that's going to look something like this. We have our target up here, our entry here, and our stop loss down in here. So that is probably, I would guess, about a 4, maybe 3 to 1 risk to reward trade. But as the trade starts moving in my favor, what I'll do is I'll move this stop loss a little bit higher, right? So maybe below these lows. And now this is like a 6 to 1 risk to reward, okay? My reward is 6 times greater than what I'm currently risking. And the closer you move your stop loss to break even, obviously the greater your risk to reward becomes until it's technically infinite, right? And that's when you get to break even. Okay, but the point is that you always want to be managing your risk and cutting your risk as the trade moves in your favor. The next thing that I've learned quite quickly is that limit orders are killing your edge. In my opinion, I don't think there is a strategy out there where you can just blindly set a limit order, for example, a level of support and resistance, and expect to have great results, or at least not optimal results, because there are always going to be those moments where price just blows through your level completely, and most of the time unexpectedly, right? Nobody ever expects their level to just get blown through, so why would you even give it the chance, okay? So blindly setting limit orders at your entry point, in my opinion, is not a good idea. It doesn't mean you don't use limit orders. You still can use limit orders, But what I like to do is I like to wait for a sign that my zone is going to hold first and then place a limit order. So if I get some rejection candles or some weak price action in my zone, then I will look to enter. But for example, in this day here, which was a profitable day, again, sent in the Discord in real time, so join that up absolutely for free. Okay, it was a pretty choppy day for me. I just barely squeezed out this profitable day. And at the end of the day, I saw this late day setup. We have the level of demand. We have our area of liquidity. Okay, so this was our order zone. And what ended up happening is that price blew right through it. And if I were to just set a limit order here, it would have been an absolute loser, right? Now, you'll see that it does look like I sold there, but that is not actually the case. What happened was that I accidentally bought right here. I put my stop loss to break even or either a small loss right around here. And that's why you see that red arrow. Just so you know, I do practice what I preach, all right? Now, expanding upon risk management and the things that I've learned over the years is that you do not want to put stop losses below lows and above highs, right? Just like we were talking about earlier, that is just going to get swept a majority of the time, right? You're going to be right where all those other orders are, so you don't want to base your stop loss off of highs and lows, right? You want to base it off something else that's more logical. What is the more logical option? Well, in my opinion, it's using ATR for your stop losses. Now, what is ATR? ATR stands for average true range, and basically what it is a measurement of how much a candle is going to move in any given candle, okay? So what it's doing is calculating the difference between the high and the low for every candle, and you set a period. For me, I use 7. So it takes the range, the distance between the high and the low for the last 7 candles, it averages out the number and then presents it in a nice little chart that looks like this. Okay, so in this case, 1 ATR is 20 points. All right, so this means that on average, a candle moves from high to low, it will move 20 points. So a great way to keep your stop losses tight, but not too tight, right? Still logical, is you use a 1 ATR stop loss. This way you're basing your stop loss off of the average moves, right? You're basing it off of volatility, the current volatility, the current amount that price is moving up and down, right? You're basing your stop loss based off of that number rather than some arbitrary high or low, right? But it still makes sense to use because, for example, if you expect price to turn around in an area, you probably don't want to see it moving its full average range against you. Okay, so from my entry point, I use a 1 ATR stop loss, and then I immediately go to a break even when we are at 1 to 2 ATR in my favor, right? So if I buy, my stop loss is 1 ATR, and I go to break even when we get to 1 to 2 ATR in the upside. The next critical lesson that I learned over 12 years is always trade with the strength, or always trade with the trend. But how do you actually do this? Well, this is one of the few indicators that I do use, and this is what we call VWAP. Okay, VWAP stands for volume weighted average price, and essentially what it does is it takes the average price, but also it factors in volume at that price. Okay, so volume weighted average price. Now this middle line here is the volume weighted average price. So think of this as like the session's average price with all the volume and all the traded prices in that session. Okay, that is the average. So that is the volume weighted average price. Now what you see here is we also have this red line up here and this green line over here. What is that? Well, this is +2 standard deviations of the VWAP, and this is -2 standard deviations of the VWAP. And basically, this is going to act as your guardrails. As long as we are in this zone here, within these two lines, you are only looking for longs. As long as you are below this zone, within these two lines, you're only looking for shorts. This is the easiest way that I've found to continuously trade with the strength and the trend and not really have to worry about counting, higher highs, higher lows, and all that stuff. Makes it very simple, okay? And we're going to keep taking a look at some more examples. But remember that example that I showed you of supply and demand, specifically the demand example, okay? This is it right here. You can see that we are trading above the VWAP pretty aggressively, but we're also not above 2 standard deviations. If you're above this red line here, it's probably not a good idea to try to buy because it basically means that you're at, statistically speaking, an overextended price. Same thing with trying to short below this green line here, the -2 standard deviation. So statistically speaking, it's just not a high probability trade. Okay, but you can see, because I was trading with the strength, all of these setups tend to work out a little bit better. Now, same thing with the short examples that I showed you earlier. Now here it is with VWAP. You can see we are below VWAP for the session, and every single level of resistance or supply held perfectly. Why? Because we're trading with the strength, we're trading with the trend, and it's because we knew that because we were in this zone here, we can look for shorts, but not buys, right? Buys would be a bad idea, and ironically, I did buy on this day, I think somewhere around in here. It was a counter trend trade, but don't recommend it. I got wrecked today trying to counter trend trade, and that reminded me of this lesson, okay? So don't be like me. Trade with the strength. Now, when you see a chart that looks like this, which is basically a flat VWAP, and the standard deviations are pretty flat as well, and it's all very close to one another, okay, this is usually a choppy market, and price will tend to consolidate and usually stay within these two lines here, okay? So these two lines are your guardrails, and whenever you are trading in a consolidation, that is when maybe you can look to counter trend trade. But in general, you don't want to be trading when price is just hovering around VWAP like this. When the VWAP is flat and price is not moving in one direction, you are more likely to get chopped out. And this is the scenario where maybe you can look for counter trend trades at the extremes. The +2 standard deviation up here and the -2 standard deviation. But this picture is really just an example of how it kind of keeps you in your guardrails. You know that you can trade anywhere in this area, but anywhere outside of this area is probably not a great area to trade. And if you're curious about the settings of the VWAP, I have them right here. I have the upper band, this is the +2, and the lower band, this is the -2. Okay, so those are standard deviations, and then I have it anchored to the session. This is if you're a day trader. If you're a swing trader, honestly, I'm not sure how you would use VWAP. I've only ever used it for day trading. Now, the next thing is probably going to sound a little bit controversial and maybe even a little bit silly, but this is something that actually blew my mind. I couldn't believe it. Basically, you don't want to spend too much time backtesting, okay? I spent years trying to backtest my strategy and never really found anything super compelling in the backtesting, right? But then I switched to a live account and I start trading like it actually depends on, you know, the money, right? It's real money now. And I start to care a whole lot more about what's actually going on. I start paying a lot more attention to what the chart is doing. And as you watch it live, you're going to see every single price tick, right? Which in the backtesting, you do not see this. In backtesting, you see one bar, then the next bar, then the next bar. You do not see the individual price movements, okay? And so what I found is that you can almost always do better trading live if you do what I'm about to show you, okay? Don't spend too much time backtesting. Spend maybe a couple weeks to maybe a couple months max backtesting a strategy. Find something that you believe to make sense, even if it's not super profitable. What you're going to do is you're going to take this strategy, a strategy that you're comfortable with, and you're going to go immediately into a live or a prop firm account. Now you're going to want to make sure that both of these, whether it's live or prop firm account, you're going to want to make sure that both of them are small accounts, okay? You don't want to be trading with anything too crazy, just something so that you can feel some sort of emotion, okay? And what you're going to do is you're going to go and start trading your strategy live. But the key difference is that you are going to trade that strategy and not change it, okay? You need to have entry, okay, entry, exit, and management tool rules, okay? You need to have entry, exit, and management rules. So you're going to define these three rules, and you're going to trade it for about 2 to 4 weeks, okay? And at the end of these 2 to 4 weeks, you're going to see, and this is more than likely, you're going to see that you got stopped out and it's not a profitable strategy, okay? This is how it always goes. And so at the end of the 2 to 4 weeks, what you're usually going to find is that you're getting stopped out and then price goes in your direction, okay? Or maybe you're getting stopped out, price goes a little bit further, and then it goes in your direction, okay? So what you're gonna do after those 2 to 4 weeks is make a note about how much you're getting stopped out, where is price usually turning around, and then usually the answer is going to be, you're going to want to make your entry, your previous stop loss, okay? So where you previously had your stop loss is now going to be your entry point, okay? And what's going to happen is that you are likely going to start getting a little bit better at timing the market. It's going to now come to your entry point rather than your stop loss, okay? Because now your entry is your stop loss. And now, instead of price hitting your stop loss and then reversing, it's going to be hitting your entry point and then reversing. Or maybe it's going to blow right through your entry, still stop you out, and then turn around. Well, guess what? Another 2 to 4 weeks goes by. Okay, you make notes, and then you now do this again. Your entry is going to be your previous stop loss, and eventually what's going to happen is eventually you will be able to find an area or a repeatable pattern where price hits that area and you have an entry sitting there, okay? Now, I know that sounds very silly and very stupid, but this is literally what I did, okay? I had live streams. I was live trading every day just for fun, and I basically accidentally stumbled upon the strategy that I'm using today. I was literally using 1 ATR stop losses as a joke to basically trade with the world's smallest stop loss. And little did I know, I discovered after multiple stop losses, getting stopped out multiple times, I discovered where to put my actual entry point, okay? So this is not a joke, right? It sounds silly, but use the same entry point for 2 to 4 weeks, and then if you're getting stopped out, move your entry point to where you were putting your stop loss, rinse and repeat until eventually you have at least a decent entry point. And what happens from there is you're going to need to work on your management. You're going to need to work on your risk management and your take profits, right? Now let's talk about prop firms. I recently got funded the other day from Take Profit Trader on my first try. Well, not my first serious try, okay, because the other accounts I blew doing stupid live stream gambling. But prop firms are a great way to get funded if you don't have a ton of money, right? If you don't have a ton of money to trade with, prop firms are a great solution. But here's the problem. Most traders fail these accounts. In fact, the statistic is something like 98% of traders do not even make it past the challenge account, okay? 98% of people won't even make it past the challenge. That means they don't even get the chance to trade a funded account, okay? Now, why is this? Well, it's mostly because people are not familiar with how to actually trade with normal size, okay? What these prop firms do is that a lot of them will let you trade anywhere between 1 to 10 mini contracts, okay? This is for futures. This is way too big for anyone on any prop firm account. Why is this way too big? Most people trade with 50K accounts, okay? And usually the drawdown for the 50K account is $2,500, okay? Now this is what people have no understanding of for some reason. I don't understand it. But people believe that they actually have $50,000 to trade with. No, you do not. You have a max drawdown of $2,500. So how much do you actually have to trade with? You have $2,500. If you lose $2,500, you don't have access to this account anymore. So your account size is essentially $2,500. Now, most people say to risk 1% of your account size. So you can see how many traders would say, okay, I'll risk 1% of $50,000, and that is going to be $500, okay? Well, at $500 per trade, guess how many losing trades it's going to take before you blow up your entire account? It's going to only take you 5 losing trades. The probability of you hitting 5 losing trades in a row within a few months of you even getting this account is very high. Very, very, very high. Okay? So if you only have 5 trades to work with, basically, you are going to blow your accounts. So when you are trading prop firms, what you want to do is take your max drawdown, okay, and basically pretend like it's your entire account balance. Now, we are not going to trade 1% of $2,500 because that means we're risking what, 25 bucks per trade? Okay, we don't want to do that because it's just going to take you way too long to actually pass the challenge. But instead, my rule of thumb is that I'll take this number, the max drawdown, and basically what I want to do is find a contract size and an average stop loss that would basically mean that I need 20 trades, losing trades in a row in order to hit this number. So for me, what this means is that I only trade micros, the MNQ, and I only trade about 3 to 4 micros, okay? If I trade 3 to 4 micros and I lose 20 times in a row, that is the only way that I can possibly hit this max drawdown. Will it take longer to pass this challenge? Yes, slightly. But will I have a much higher chance of actually getting funded and slowly grinding away those profits and over time getting funded and getting payouts? Yes, you will do much better if you trade this way rather than trading based off of the entire account size. You do not actually have $50,000 to trade with. You only have your drawdown to trade with. So you want to find the contract size, always going to be micros, do not trade minis, always going to be micros. You want to find the contract size that is usually about 10 to 20 trades is my rule of thumb, okay? Find the contract size and about your average stop loss, to which if you lose 10 to 20 trades in a row, then that will blow your account, okay? 20 if you want to be safer, 10 if you want to be a little bit quicker and try to just pass that thing, all right? And speaking of prop firms, if you do want to try your shot at getting funded and you want to try the strategies that I teach you here, I have links in the description down below that have all of the best prop firms and discounts, and there's even more of them over on the Discord. So just join all that, link in the description down below. Make sure to smash that like button and subscribe if you enjoyed, and I'll see you in the next one. Peace.